Happy Monday, everybody. Today is January 12th, 2026, and this is your Monday market update. 1 week into the new year, markets are sending a fairly consistent message. Investors are willing to look past the noise and focus on fundamentals. That doesn't mean risks have disappeared, but it does suggest confidence is coming into 2026, and it does remain intact. Back into the markets, let's recap last week and let's preview what's ahead. The first trading day of the week opened with investors putting money back to work after the holiday break. Early headlines were dominated by the U.S. action in Venezuela and rising geopolitical tension, but markets largely treated it as background noise. Energy stocks benefited from firmer crude prices. Financials participated as growth expectations carried over from late 2025, and softer manufacturing data did reinforce expectations that the Fed can remain patient. By the close, the Dow was up just over 1%, S&P up about 2/3 of 1%, and the Nasdaq was up just under 3/4 of 1%. As trading continued into Tuesday, momentum carried forward. Optimism around artificial intelligence resurfaced following upbeat commentary tied to the CES, lifting semiconductors and select mega cap tech stocks. As At the same time, global economic data continue to support the idea of a slowdown without a breakdown. Growth cooling just enough to keep inflation pressures in check. By the end of the day, the Dow was up roughly 1%, S&P up about 0.5%, and the Nasdaq was up just under 0.5%. Midweek brought a pause. Markets pulled back from record levels as investors digested weaker labor data from JOLTS and renewed policy uncertainty tied to housing, defense spending, and restrictions around dividends and buybacks. Energy stocks retreated as crude prices slipped, while financials also gave back some early year gains. Notably, despite the pullback, selling pressures remained orderly. One notable area of volatility midweek was defense stocks, which experienced some sharp swings driven by policy headlines rather than fundamentals. Earlier in the week, shares pulled back after the president publicly criticized defense contractors over production timelines and cost controls, while also signaling restrictions on dividends and buybacks. That pressure reversed quickly, though, after the president later in the day emphasized plans for significantly higher future defense spending, helping defense names rebound. The episode was a clear reminder of how quickly sentiment can shift when policy rhetoric changes and how headline-driven moves can exaggerate short-term volatility. At the close Wednesday, the Dow was down just under 1%, S&P down about 1/3 of 1%, and the Nasdaq was up just a touch, finishing slightly higher on the day. On Thursday, leadership rotated. Investors moved away from some of the most crowded AI trades and into more cyclical areas of the market. The Dow benefited from strength in industrials and defense stocks, while technology lagged as profit-taking continued. Oil prices rebounded, helping stabilize sentiment, but the Nasdaq remained under pressure. By the closing bell, the Dow was up just over 0.5%, S&P essentially flat on the day, and the Nasdaq was down just under 0.5%. The week ended on a strong note after Friday's December jobs report. Payroll growth came in modestly below expectations, but the unemployment rate ticked lower. Investors interpreted the data as just right. Firm enough to support growth, soft enough to keep the Fed from rushing into policy changes. Home builders and rate-sensitive stocks rallied, helping lift markets into the close. For the day, the Dow was up just under 0.5%, S&P up about 2/3 of 1%, and the Nasdaq was up just over 3/4 of 1%. For the week as a whole, participation was broad and encouraging. The Dow finished up just over 2%, S&P gained a little bit more than 1%, and the Nasdaq rose close to 2%. Small caps outperformed, international markets moved higher, and leadership rotated beyond mega cap technology. Healthy signs early in the year. Bonds also posted modest gains, commodities strengthened, and the gold and silver moved higher amid lingering geopolitical uncertainty. This wasn't just a rally driven by one theme, it was a week defined by breadth. Let's look at the week ahead. This week shifts the focus from market momentum to hard data and earnings. Earnings season officially gets underway, led by the big banks this week. JP Morgan, Wells Fargo, Bank of America, Citi, Morgan Stanley, and Goldman Sachs, they will all report, offering insight into credit quality, loan demand, and how corporate leadership views the economic backdrop for 2026. Jamie Dimon his post-earnings commentary in particular will be closely watched. We'll also hear from Taiwan Semi, a key bellwether for global demand tied to artificial intelligence and capital spending trends. And on the economic front, we're going to get December inflation it will take center stage with CPI on Tuesday and midweek PPI. Markets will be sensitive to any signs of inflation stickiness, especially in core components. Retail sales will also provide a read on the health of the consumer, following the holiday season, alongside housing data and some updates on the federal budget. Several Fed officials are also scheduled to speak throughout the week, likely reinforcing the message we've been hearing. Inflation has improved, the labor market is stabilizing, and policy decisions will remain data dependent. Now, Fed head bingo is back. Bostic, Barkin, Williams today, Musala and Barkin again Tuesday, Paulson, Moran, Kashkari, Bostic, and Williams pack Thursday's airwaves, and Bowman and Jefferson will be on Friday. So far, the message from policymakers has been consistent, acknowledging progress on inflation, a stabilizing labor market, and a desire to remain patient and data dependent rather than rushing policy decisions. This ties directly into Friday planning video from this past week, where we talked about the importance of staying disciplined, especially early in the year. Strong starts can create recency bias, making it tempting to chase what's worked most recently. Last week was a good reminder that markets rotate, leadership changes, and plans, not predictions, are what carries investors through full cycles. Stay focused on your strategy, not the noise. As always, we'll keep watching the markets and keep you informed. Have a great week.